John Bogle is known as the father of passive or indexed investing, creating the first investment fund that allowed private investors to index themselves to the S&P 500 index, paying low fees for the first time and preventing individuals from falling prey to management funds with false expectations and high fees that led people to fail in their investments in stocks and the stock market. Although Bogle passed away in 2019, his firm, the Vanguard Group, his investment strategies and lessons are today among the most important in the world of investments. His legacy is found in his main works, among which stand out The Little Book to Invest with Common Sense and How to Invest in Investment Funds with Common Sense. This is the history and investment principles of the founder of Vanguard and passive investment index funds and exchange-traded funds, or ETFs. John Clifton Bogle, better known as Jack Bogle, was born in 1929 in the city of New Jersey in the United States. His family lived through a difficult economic situation because they lost all their assets in the Great Depression that occurred in the United States, coincidentally, in the year of his birth. His father had serious problems with alcohol consumption, which led to his parents separating when he was just a child. He attended Blair Academy as a child, and despite family problems, Bogle showed a talent for mathematics and numerical reasoning as a child. Due to his excellent academic results, young Bogle was accepted into the renowned Princeton University, where he graduated as an economist in 1951, with a meritorious thesis thanks to his research in the field of investments and investment funds, where he managed to demonstrate how most investment managers fail to outperform the market, that is, the performance of the S&P 500 index. Bogle demonstrated how due to the costs of management fees, taxes, and other charges for active investment in funds, the returns are lower than those of the S&P 500 index. This thesis is still valid today, because when reviewing Morningstar reports in recent years, with long time horizons, on average passive management has a better performance than actively managed funds. His first job was at the Wellington Fund, where due to his excellent results he managed to rise until he reached the position of assistant manager in 1955, where he achieved the capacity and autonomy to establish the strategy of the fund manager, structuring a completely new fund. Later his rise continued to reach the position of director of the company. Although initially the results of his management were quite good, the decision to carry out a business merger led him to one of his greatest failures, which even caused him to be removed from the board of directors. Although he held a position as director of funds, but without the autonomy to manage the portfolios. That failure would later become his greatest success, because the impossibility of managing the funds led him to look for a solution where a manager would not be needed for the funds. His proposal for an unmanaged fund would be a turning point in the entire investment fund industry. In 1974, Bogle founded the legendary firm the Vanguard Group, which would become one of the most important investment firms in the world over the years. It was in 1976 when, following past failures, Bogle structured the first investment fund that did not have active management, that is, one that did not have a group of managers who were defining the assets and shares that should be bought or sold. The fund was called Vanguard 500 Index Fund, and it was the first index fund in history where anyone could invest resources. The concept, which today seems very simple, was to have a fund that would replicate the behavior and composition of the S&P 500 index, which brings together the 500 most important companies listed on the stock exchanges of the United States. At its launch, it managed to raise $11 million. But by 2022, the fund had assets worth $709 billion. The role of the fund managers was marginal, since a team of specialists would not be needed, but rather professionals who would perform an operational task, which allows for a reduction in costs and a lower payment of commissions by clients, in addition to minimizing the risk of human error and conflicts of interest in the management of the funds. In addition, Vanguard's clients would become shareholders, since index funds acquire all the company's shares. The main elements of John Bogle's investment strategy and philosophy are the following. First, outperforming the market is extremely difficult. Bogle believes that outperforming the market, that is, achieving a better return than the S&P 500 index, which is 10% per year on average, is quite complicated in the long term. When reviewing the average return of individual investors, the return statistically lies between 3% and 5% per year, even in some cases with significant losses. There are few managers, most of them professionals with considerable experience, who manage to outperform the index in a sustained manner over long periods of time. Even the vast majority of actively managed investment funds, which are managed by experts, fail to outperform the S&P 500 index. Bogle claimed that trying to outperform the market was more of a loser's game, and having long-term positions in S&P 500 index funds was more of a winner's game. Therefore, ordinary people should look for a simple strategy as the best investment decision, which for the vast majority is to invest in an S&P 500 index fund with the lowest fees on the market and sustain their investments over the long term, because it allows them to invest in the best companies, taking advantage of opportunities without the need to make decisions about the companies in which to invest, because we do not know how the market will move in the coming years and which companies will perform best. One of Bogle's famous phrases in this regard was, "Don't look for the needle in the haystack, just buy the haystack." In other words, it was not necessary for a novice investor to wear themselves out looking for the best stocks to invest in, with a high probability of making a mistake. It was better to invest in an index fund, which for Bogle was the haystack, where one invests in the best companies passively without being an expert in the selection of stocks from different companies. For John Bogle, the market is efficient in the long term. Bogle also explained that although investment in bonds reduced risk, in the long term it was better to focus on stocks because their performance is better, on average 10% annually, and to reduce the risk of investing in stocks the strategy is to project the investment over long periods of time, because over 20 years the historical probability of earning returns by investing in the S&P 500 index is 100%. In some cases, investing in bonds is advisable to have a kind of insurance against short-term market falls, additionally allowing investment portfolios to be diversified. Second, management costs as a relevant factor. Active funds have high fees for their clients, in some cases over 2% per year, which negatively affects the results of the fund and therefore of the investors. This means that individual investors pay too much in fees, in funds that rarely exceed the performance of the S&P 500 index. On the contrary, an index fund allows savings in the payment of fees, in addition to generally having a better performance in the long term. The index fund can have a fee of only 0.05%, well below the fees of active funds, which in some cases are over 2%. If a private investor invests in indexes, due to the cost savings in management fees and an average return of 10%, he or she is able to benefit from compound interest, achieving excellent long-term returns. Taking into account average returns over a 50-year period, $1 invested would yield a profit of $10 in an actively managed fund, while in a passive or indexed fund the profit would be $30, a return 3 times higher than that of passive or indexed funds. Third, passive management is the best alternative for private investors. Taking into account the reduction in costs in the payment of commissions and the better long-term performance, passive management is an excellent option for ordinary people looking to invest in shares. Index funds and ETFs or exchange-traded funds allow in a simple and efficient way to access very good returns in a sustained manner. Bogle proposes that every investor should select funds with low management costs, taking into account that past returns of the funds are no guarantee of future returns. It is also important to be very cautious with managers who have had good results in the past, since the returns achieved do not guarantee that they can continue to beat the market in the future. Another element to take into account is to avoid investing in an excessive number of funds, trying instead to maintain long-term investments, a concept known as buy and hold, which means buying and waiting for investments to mature without being affected by human emotions or by short-term market and media noise, which leads some people to panic and liquidate their positions, in some cases with losses. Fourth, accurately evaluate the returns of funds and investments. Bogle shows how investors often have a fairly narrow window of observation of the results of a fund, since in some cases the returns achieved by the managers are reviewed in only 6 or 12 months, often in bull markets. But an intelligent investor should consider the returns over longer periods of time, both in economic cycles of economic growth and recession. In particular, investors should pay special attention to observing the results obtained in bear markets, since it is during these periods that it is more difficult to obtain good results. One of the problems when selecting a fund is that in some cases when there are good results, the funds grow too much and it is possible that due to their size it will be more difficult for them to find good investment ideas in the future, causing the returns to not be as expected. Fifth, time is a fundamental factor to achieve good results in investments. It is essential for a private investor to try to start investing as soon as possible, because in order to benefit from compound interest, the passage of time and being invested for the long term are some of the most relevant factors to obtain good returns. In the following graphs, we can see how if the time invested in the market is increased, the benefits increase exponentially, and a large part of the accumulated capital is thanks to the benefits due to the effect of the time invested. Bogle also explained how time is another key factor in reducing investment risk, since the longer the investment term, the lower the risk of losses, since volatilities are generally short or medium term and the market and the S&P 500 index have an upward trend in the long term. The longer the investment term, the greater the probability of achieving the average return of the S&P 500 index of 10% per year. Bogle considered that time was an element that allowed to differentiate between investment and speculation. Since investment was looking for long-term ownership in different companies, trying to estimate their intrinsic value, while on the contrary, speculation sought to obtain short-term benefits from falls and rises in the markets, without taking into account the fundamental aspects of the companies. One of Bogle's postulates regarding time management in investments was, "Time is your friend, impulses are your enemy." This made it clear that emotional control is a determining factor, because if a person cannot bear a 20% loss in the stock market, he or she should not invest in stocks. One must have rational expectations, because in some cases the market rebound and recovery takes only a few months, but in other cases it can last even a few years. This means that only the resources that will not be needed in the next 5 years should be invested in stocks. Regarding time, Bogle also stated that if regular contributions were made by investing continuously on a regular basis, the average return could be achieved, concentrating on the long term, avoiding short-term noise and distractions. Sixth, the importance of sound investment decisions. Bogle explains how one factor to take into account to improve investment results is to take into account the issue of paying taxes, since some investors do not give much importance to this aspect, but it is essential to keep in mind that when positions are sold depending on current laws, a significant part of the profits must go to paying taxes. Therefore, when an investor makes frequent stock purchase and sale operations, he must carefully consider whether paying taxes may affect the expected returns. On the other hand, John Bogle stated that the investment fund industry had become more of an entertainment industry, where fund companies often take advantage of the lack of knowledge of private investors to promise returns that are not possible and charge exaggerated management costs, or in some cases hide fees and administration costs. In some cases, funds do not seek to reward clients, but rather seek to guarantee resources to pay high salaries for directors and managers, resources that come from commissions paid by clients. Bogle also explains the importance of managing emotions by investors, since the increase in internet coverage allows investors to have greater access to different investment products and intermediaries, but on the other hand offers a greater temptation to make mistakes, since there is the possibility of carrying out operations with an immediacy that does not allow the analysis of the operations carried out. In some cases, some investors may carry out operations looking for quick profits, operating emotionally, which can lead to successive losses, trying to obtain dopamine releases similar to those of betting players. Seventh, the strategy for novice investors. For novice investors, Bogle proposes that they should initially invest virtual money and train themselves to later make investments with real money. While looking for brokers that are registered and regulated by recognized entities from countries with solid institutions, in addition to achieving low commissions on the funds in which they invest, and looking for intermediaries or brokers that manage to offer a good number of alternatives in the financial markets. In the description of the video, you will find the link to the best course to learn technical and fundamental analysis to invest in stocks. There is also the link to the best platform to buy stocks on the stock exchange, regulated in the United States. And finally, if you want to support us, there is the Patreon account so that you can support us in creating more content.